trade war accelerated to unprecedented levels this week.
And the markets, well, they are plunging in response. So what does all this mean for Australia? This has got to be making him anxious, surely.
Going big or going home. And I think he has enough political capital in the United States at the moment.
Australia will be impacted by a 10% tariff on all goods imported.
Bruce, these are widespread and wide-ranging, which will have global ramifications for Australia.
The US president revealing plans now to impose.
Trump mentioned these reciprocal tariffs.
Unpredictability is a feature, not a bug. So all of us are still trying to understand precisely what he has in mind.
There is a lot happening at the moment. And as this says, the world is crumbling. And here is what you need to know. I'm going to go through in a bit of detail what is happening in the world right now, what the US tariffs are doing. We'll compare it a little bit to what happened in the GFC and even COVID. But if you want this in full detail, you should really jump onto our webinar, and I'll show you at the end of this video how you can join our upcoming webinar. But for now, let's have a look at what Peter Dutton is saying. Peter Dutton is currently claiming that Australia is headed for a recession amid Trump's tariff turmoil. How is that going to affect Australia? How is that going to affect Australian property? Is it going to cause us to grow even higher? Or are we looking at an upcoming recession and a bust of our property market? If we look at Australian property is quite unique in comparison to the rest of the world. So if we look at some of the features and benefits of Australian property in the market, we have a bank reserve system in place. We have trusted and formal lending as well. And that lending also helps you take equity out of your property. We also have a preference in our population for home ownership. When we compare that to other areas of the world, most other countries, their population does not want to own their own home. They are happy renting. They are happy just living in somebody else's property. Whereas in Australia, we want to own our own home. We want to own property and we want to live in the property that we own. We also have a number of other benefits in Australian property, including negative gearing for tax purposes, capital gains discounts, government first home buyer incentives, and the list goes on. As I mentioned, I really want to look at what happened during the GFC because we can definitely see some similarities to what is happening today. For many of us, we probably weren't really in the property market 2007, 2008, but we may be aware of the global financial crisis and what happened in 2007, 2008, where global stock markets and share markets crashed around the world, which pushed a lot of economies into turmoil and into panic. There was investors panicking around the world. Even in Australia, people were still unsure of what would happen and what they could do as well. Off the back of this, our RBA did drop rates by 0.5% in September 2008. So it really didn't take them long to start taking action to help our own economy and our own property market. Because what happens when rates drop, our borrowing capacity increases. So they wanted to help people get into the market to boost Australia's economy. This rate drop in 2008 was the first drop in 7 years. So they knew that they needed to take action. As well as the RBA dropping rates, the government also stepped in with a number of first home buyer incentives, again, to help people get into the market. That first homeowner grant is actually still in place today, albeit with a few changes, but it's stuck around. And I'm sure many people aren't aware that this stemmed from that 2007-2008 GFC period. They also introduced a boost on that first homeowner grant, which made the grant increase up to $25,000 for purchasing new property as well. If we fast forward to that 2008-2009 period, rates dropped from 8 to 5.5%. So that is a huge drop that we saw after the government implemented their incentives, further pushing driving their economy up and pushing people to buy property as a stable market in Australia compared to what was happening in the rest of the world. So if we look at what that looks like for us, if we look at that 2007-2008 period, interest rates were up at 8%. The median property price was $470,000, which was relatively affordable for the time. Fast forward to that 2008-2009 period, interest rates dropped dramatically down to 5.5%, like I mentioned. And that saw the property market start to grow. That green window there is really the ultimate time when we saw people purchasing property that benefited the most from that post-GFC property boom as well. Obviously, the interest rates fluctuated slightly, but property prices continued to grow after that. So what did we learn from the GFC? We learned that property is a safe haven during market uncertainty. The government does introduce incentives whenever there are global markets that are uncertain. The RBA lowers cash rates to encourage property ownership and property purchase. Banks will also lower interest rates to remain competitive with each other. So on top of the RBA dropping interest rates, the banks will lower their interest rates to remain competitive in comparison to each other. Lower rates also, as I said, means a higher borrowing power. When we have a higher borrowing power, we see more people enter the market, and they will enter the market in that affordable price bracket. No one is wanting to overshoot what they can afford, especially in the current cost of living crisis, and they had a similar situation during the GFC. If we fast forward to today, as I mentioned, we can see some similarities happening. 2024 towards the end and early 2025, Trump started to talk about introducing his tariffs, and in the end of Q1, early Q2 of 2025, he did introduce those tariffs globally and started a trade war, and we immediately saw stock markets slowly decrease. We saw different big brands that we know, Nike, Lululemon, etc. We saw their stocks fall as well because of the increased tariffs, especially on China. The Australian dollar was also devalued earlier this quarter in early April because of the market uncertainty around the world. Stocks were down here as well, around 25%. If we start to look at some of the headlines, we see one here that big banks are predicting that the RBA is going to lower rates. Now, there are multiple banks that have come out and said that in our May 20 RBA meeting, rates are going to drop by 0.5%. Now, that is huge. If we compare this though with the GFC, we also saw that first rate drop after the GFC happened was 0.5%. There are more similarities coming into play again. With the recent news coming out, on top of it, there is also the election happening, but the government and the coalition are also coming out with promises for first home buyer incentives, including the first home mortgage deduction scheme, meaning that as a first home buyer, if you buy, I believe, new property, you'll be able to have a deduction on your tax for your mortgage repayment, which is huge. Basically, it's currently a deduction that only investors can claim, but the promise at the moment is that first home buyers will also have the same. Also, moving forward to 2025 and 2026, what is that going to look like? Banks are already coming out saying that interest rates will be down around 3%. I think some are even estimating 2.8%, which again is very low in comparison to where we are now. But what happens if rates are down around that 3% mark? So let's have a look at today, the red box on the left there. Interest rates are currently around 6.5%. Your maximum borrowing capacity on an average income is $370,000 to $420,000. If we fast forward to interest rates being 3%, you will have a 57% increase in your borrowing capacity. That's $245 more that you can borrow. So bringing you up to that $600,000 to $650,000 borrowing capacity. Now that is going to open up so many doors for people that previously could not get into property. And that is the crucial element here. If you could purchase property already before, they're not the people that we are worried about. We are concerned as investors for the market that could not previously get into property, but now with these rate cuts will be able to enter the market because they will enter the market in this $600,000 to $650,000 price point. This is the area of the market that is going to see the biggest growth and the biggest injection from investors and home buyers in that bracket. So if we look at these price points, as I said, people need to start looking at their cash flow analysis of what they can really afford. But that $600,000 to $650,000 is going to be crucial, and we don't want to wait before jumping in. So when the interest rates are due to drop on the 20th of May, the demand for property in this price point is going to skyrocket. This price point, if this is where you are currently looking at, there's not going to be any stock left at this price point because the demand is going to go up very quickly. So you do not want to wait. If we do look at a similar graph that we looked at with the GFC, we can start to, I guess, predict and see a vision for what the future will look like for property. 2024 to 2025, our interest rates are currently sitting at around 6.5%. We're estimating that by early 2026, interest rates will be down to 3%. So what is going to happen considering median property prices are currently $600,000 around the country, but especially in Melbourne as well, which is where we believe is going to have the best growth in 2025. What is that going to look like? What will interest rates look like? What will property prices look like? We saw previously after the GFC, average property prices almost doubled. Are we going to see the same thing? Which means that average property prices will be, around that $1 million mark, 1.1. People will start to be priced out of the market yet again and make it impossible for you as first home buyers and investors in that affordable bracket. You will not be able to enter the market. So you can't wait. This is the time to invest before the 20th of May. Before that announcement happens from the RBA that interest rates are going to be dropped, that is going to be the catalyst for the beginning of this curve. So if you are not getting in the market before then, you will be too late. On that point, as I mentioned at the beginning, I am presenting at an upcoming webinar. If you're seeing this on YouTube, check the notes in the description. I'll pop the link there for you to join the webinar. If you're seeing an ad, you can click the link anywhere on the screen that you can see and it will take you to register. I present a Women in Property webinar with another colleague of mine, and we present purely for women getting into property investment, and I look forward to seeing you there.